All right, traders, this is Scott Barkley at ProAct Traders. This is lesson 5 in a 7-lesson series, how to find the big boys targets. And lesson 5 is understanding the average true range. It's going to be one of your first things you're going to use in order to find the big boys targets. So let's go see how we use it.
There's some other things we got to look for. What is the ATR? ATR stands for the average trading range, okay? And all trades must be filtered through the ATR. The ATR starts at 5 p.m. Eastern Time and goes 24 hours. So every day at 5 o'clock is a brand new ATR for that. It's the average true range of that currency, all right? So, for instance, a currency that has an ATR of 75 pips in a 24-hour cycle could go only 45 pips today and could go as much as 100 pips tomorrow and still be keeping its average of 75 pips. You see, because it's over, we use a 14-day period, all right? So if you open the charts, you know the ATR is 75 pips, the currency has done only 20 pips, you might have an opportunity. But if it's gone 60 pips, you do not have an opportunity, no matter what your indicator says, which is one reason why indicators won't work, because they don't know the ATR. They give a signal right after the currency has finished 75 pips. Why did they give a signal? Because currency, all indicators but the MACD are lagging. They never tell you what the currency is going to do. They only tell you what it has done. And if it's gone 75 pips to the upside, your indicator is going to give you a trade to the upside. And if you take that trade and then it's over, they've done the ATR, now we need to do an ABC correction so everybody knows what we're going to do. What ends up happening? Daggone it, the broker stopped me out again. No, the broker didn't stop you out, okay? So let's take a look at the ATRs. We have a little script that we run every day that does this, okay? So there's the 14-day, then there's the 90-day, and the 180-day, okay? So for instance, you can see pretty clearly here, let me change the color here, that right now the euro dollar is doing 72 pips a day, all right? In a 90-day period, it normally does 84, and typically in 180 days, half a year, it normally does 87 a day. So it's significantly lower than it was. You see that? All right. And that's the same thing, for instance, the dollar Swissy. Right now it's only doing 49, but in 90 days it usually does 60, and in 180 days it usually does 65. We're empowered with information using this information, okay? So we can tell what a currency has a likelihood of doing today and how much has it already done. So at 5 o'clock, the ATR shows up, and then we go to, wake up to do the London or London market, all right? And the euro dollar has done 50 pips before that. We don't have a trade on the euro dollar. We only have 22 pips left, all right? That's all that's left. All right? And remember, this is an average, so it does this day in and day out. Statistically, that's what we're looking for. All right? So the euro dollar has an ATR 72 pips. All right? And everybody wants to trade the euro dollar. Why do you want to trade the euro dollar? Because it's only 1 or 2 pips to get in, man. That's why I like to trade it. Yeah, well, that makes a big difference when you're trading for 5 to 8 pips and you only have to pay one pip for a spread. That's great. But if you're going for 72 pips, it doesn't really matter. Okay? So there are 3 major sessions per 24-hour period: London, New York, and the Asian market. If you just divide 72 pips by 3 sessions when it's traded, that means that statistically the euro dollar only goes 24 pips per session. And the average retail trader wants his trade in and out during the session that they're trading. All right? Now, here's the deal. The bankers don't care about that. They're here for the whole session. All right? They're here, and what they're trying to do is get all 72 pips, all right? So the Asian guy is trading the euro dollar, and the London guy comes on. He tells him where the targets are, what he's looking for, and where. Tells him how much of the ATR he's already done, and that guy comes in, and he tries to take it to the 72 pips. All right, that's what happens day in and day out. But the retail trader's not thinking like that. The retail trader thinks the trade's going to go. My indicator my moving average crossover just happened, and we're going to rock and roll. And that's probably not going to happen. All right. So notice something else here. Right. Here's the Aussie dollar. Okay, 56, 62, 62. Here's the Aussie dollar, 75, 75, 78. You see, already you're seeing it's roughly doing the same thing no matter what happens, okay? Here's the CAD yen, 76, 73, 78, okay? Here's the New Zealand yen, 69, 66, 71 pips, all right? Down here, Aussie Swissy, 52 pips, 58 pips, 60 pips, okay? Day in and day out for a period of 6 months, the Aussie Swissy does between 52 and 60 pips, day in and day out, day in and day out. Is that important information? Absolutely. Because when you open up the charts, how much of the ATR have they used? If they've gone 2 pips, you might have a trade for 50 pips, right? If they've gone 40 pips, you don't have a chance of making a trade. Well, but your indicator will tell you to take it. And if you don't know this information, you take the trade, it goes up 8 more pips, finishes as 52, and then it corrects back down because professional buyers won't buy at the top. They're going to buy at the bottom. And what ends up happening? You end up with a loss, right? Well, the broker stopped me out again. No, the broker did not stop you out again, all right? So why do you need to know the ATR? If a pair statistically has an ATR that goes 90 pips and it's done 75 pips, no matter how good your trade setup looks, it is not a statistically valid trade setup. And indicators have no clue what the ATR is. None whatsoever, right? So if you take that trade, you're not trading. You're gambling. That's what you're doing. Most retail traders who use indicators to tell them when to enter a trade do so because they don't know the structure, they don't know where the trade is trying to go, they don't know the ATR of the pair, and therefore as soon as it looks good, you enter, and then when it's going against you, you click out. All right? So the average winning trade of a retail trader is only 5 to 8 pips. I used to be a consultant for FXDD. FXDD at that time was the second largest retail trader broker in the world. Okay, I was up in the pits one day and I was talking to the traders who run the board, and I said, "Tell me, what does the average retail trader get? You guys are the second largest group of traders, broker in the world with retail traders. What is the average retail trader's winning trade?" They told me 5 to 8 pips. That's it. And 90% of all retail traders will fail. You'll see that in a later lesson why that happens. Okay? So why do they do this? Well, because clever marketing has convinced them that they can learn to trade in a matter of weeks. You can't learn to trade in a matter of weeks. Get it out of your head. All right? So the ATR actually shows the ability of a currency to do the Fibonacci sequence that you learned in last lesson. 21, 34, 55, 89, 144, 233, and 377, okay? This is a sequence that you need to measure because they're doing this day in and day out, all right? So we have the first move is 34 pips. That's on the Fibonacci sequence, okay? It's the intraday first target, and it's why we have T30s on our charts. We have a set of T30s on our charts. Let me go show them to you here real quick. All right. So let me pull over here to, I'll just go to the euro. All right. So here we go. Let me take this down to a lower chart, the 10-minute chart. All right. And you'll see that the market, all right, what does it do when it comes down? Okay. So here's the euro dollar. Here's a T30. These are T30s. You see this little grid running up here? It goes all the way up. It starts over here. It's called the grid base. That's based off the pivot point, which is a thing that big boys use, okay? It's based on the pivot point and changes every day, okay? And these are 30 pip targets, okay? So when you took off here, you knew there was a target here and a target here. Even if you don't know where this thing is, you already know where that is. And there's 60 pips right there. What? 2 T30s, 1 T30, 2 T30s. Now, why do we do that? Well, because the first Fibonacci sequence is 34 pips. If you take the spread out of it, it's around 30 pips, right? So that's why that's there, right? Okay, so now 55 pips is the minimum trade a big boy can trade for. If he doesn't have a space of 55 pips, he can't push the button because you can't. The average professional trader at the bank is trading about 20,000 standard lots. Okay, and if you will get fired if you walk in there and say, "Boss, I only got 5 to 8 pips on this." You mean you risked millions of dollars to make $50,000? Don't let the door slam you on the way out. Right? That's what will happen. All right. So you can see these currencies that I've got in orange here are doing roughly 55 pips a day. All right. So 49 pips. Okay. 66, 56, 48, 44, 69 and 52, 67. You see that? Okay. Now, then 89 pips is the next number on the Fibonacci sequence. 21, 34, 55. What's next? 89 pips. So 89 pips gives us these right in here. These currencies are running around 89 pips. Okay, you see these are down. This is down, but typically it's doing 84 to 87. All right, and the next one down here, 113 pips. All these are 76, 118, 100, around 90 pips. Remember, it's an average, so it can be 76 and all the way up to 118 and still show an ATR of roughly 89 pips. Okay, there you go. Now, 144 pips, the higher ATRs can do that. Currently, the only one that can do that right now is the pound New Zealand. And it typically goes, right now it's doing 129 pips, but over the course of 6 months, it does 146 to 156 pips every day. All right, and it also has a bigger spread. Why does it have a bigger spread? Because it's more volatile. All right, ATR is measuring its average true range. It is more volatile currency, so the broker has more risk, so he has a higher spread on it. Okay, all right. So the higher ATRs can do that, and then when they come back, you can see here, for instance, the pound Aussie. It could easily, when we start getting it, be doing 139 pips. You could do it. Here's 132 pips for the pound yen. You see that? All right. Okay, so we have to know the ATR every single day. All right, so there is an ATR page on our website.
All right, so this is a couple of examples from the real world chart. Excuse me, a real world chart. And you see I'm on the Euro Aussie right in here, and you can see that the Euro Aussie has a 123 pip ATR. Its average is 110. All right, so right here is where the 5 o'clock candle starts, right here, and going up exactly 123 pips puts you right there to the pip, right? Makes a turn over here, comes down. This is the 5 p.m. candle. You take the open of the 5 p.m. candle. It is actually the close, but that is 1 second before the open. All right, so you'd use the open, not the wick or the body or whatever the open is. All right, so from here down 123 pips to the pip, to the 123 right there. So there's a good example. I'll give you a couple of more. All right, here's another example, and currently up here on the what currency is that? Can't see it. Doesn't matter. No, it's the Aussie dollar. All right. So 5 o'clock candle is right here. 5 o'clock. There's the open right there. It opened at the top right there, and right straight down to its ATR target, to the pip. All right. All right. Over here on the Euro Yen. All right, so the 5 o'clock candle was right there, and you can see right down, and that's where they put the extra. And when they put the little extra in here, the next day you'll have a 1 or 2 pip increase in the ATR. See, pretty simple. All right. All right, here we are on the New Zealand yen. All right, 5 o'clock candle was right here, right there, and where did it go? To the pip, to its ATR, to the pip, which is normal, by the way. And here's the last one to show you here, although they happen every day. I could show you to every single day. Here's where it opens. We're on the New Zealand dollar to the pip, to its ATR. See where they exited their trade there. And why do they do that? Because they know the ATR. All professional traders know the ATR. Why do they know that? Because the bankers at the bank level, they all know the ATR because they're making the ATR. So they know exactly where to exit or to pull their push their stop so that they protect their profit. And because they know that, we have to know that.